You walk into a dealership, you find a car listed at $30,000, you put down $3,000, you finance the rest, sign the papers, drive off the lot. 5 years later, you've paid $35,000. Most people think they paid for the car plus a little extra, but what actually happened is you paid for the car, a service fee to rent money, mandatory protection products, and you absorbed a loss the moment you left the parking lot. The sticker price is just where the math starts. A car loan isn't buying a car with delayed payment. It's entering a multi-layered system where several parties extract value at different stages, and the buyer covers all of it. The dealer wants to move inventory. The lender wants long-term revenue. The insurer wants guaranteed premiums. And depreciation happens automatically, whether you're aware of it or not. None of this is hidden. It's just structured in a way that makes the full cost hard to see until you've already committed. Let's start with the biggest piece, interest. When you finance $27,000 at 6% APR over 60 months, your monthly payment is about $522. Over 5 years, you'll pay roughly $31,320 total. That's $4,320 more than you borrowed. Here's what's happening. Interest accrues daily on the remaining balance. Early in the loan, most of your payment goes to interest because the balance is still high. In month 1, maybe $387 goes to interest and only $135 goes to principal. By month 50, it reverses. Most of the payment chips away at what you owe. This is called amortization. It's designed so the lender gets paid first, consistently, throughout the life of the loan. You're not paying the same amount toward the car each month. You're paying the same total, but the allocation shifts. From the lender's perspective, this makes sense. They want predictable income, and they want to recover their profit early in case you default or refinance. From your perspective, it means the car costs more than the amount you borrowed, and you don't see that clearly until you add up all the payments. Then come the fees, origination fees, documentation fees, title and registration, sometimes the dealer processing fee. These vary by state and lender, but they typically add $500 to $1,500 to the loan amount. And here's the key. Most of these get rolled into the finance total. So, you're not just paying interest on the car, you're paying interest on the fees too. A $1,000 doc fee financed at 6% over 5 years costs you about $1,150 by the time it's paid off. You're paying interest on a service charge. Why do these fees exist? They cover administrative work, processing paperwork, filing with the DMV, managing the loan setup. But they're also profit centers. Dealers and lenders price them as high as the market will bear. You rarely negotiate them because they're presented late in the process, often bundled into the monthly payment figure. By that point, most buyers are focused on whether they can afford the monthly number, not what's inside it. Next, insurance. If you finance a car, the lender requires you to carry full coverage, collision and comprehensive, until the loan is paid off. This protects the lender, not you. If you total the car, they want to make sure they get their money back. You're required to insure their interest in the vehicle. Let's say full coverage costs $150 a month. Over 5 years, that's $9,000. If you owned the car outright, you could choose liability only and pay maybe $60 a month. That's a $5,400 difference. The insurance isn't part of the loan, but it's a mandatory cost triggered by the loan. Without financing, you'd have the option to reduce this expense. With financing, you don't. Some lenders also offer, or quietly include, gap insurance. This covers the difference between what you owe and what the car is worth if it's totaled early in the loan. Why does that gap exist? Because of the next part. Here's where it gets strange. The moment you drive off the lot, the car loses roughly 10% of its value. By the end of year 1, it's lost about 20%. By year 3, it's worth maybe 60% of what you paid. But your loan balance doesn't drop that fast. By the 12th month, you might owe $24,000 on a car now worth $22,000. You're underwater You owe more than it's worth. Depreciation isn't a fee. It's not charged by anyone. It's a market reality. Cars are depreciating assets. The moment they're used, they're worth less. But here's why it matters. If you try to sell or trade the car before the loan is paid off, you still owe the full balance. The loss is yours to absorb. If you finance $27,000 and the car is now worth $20,000, you need to come up with $7,000 just to break even, or roll that negative equity into the next loan, which starts the cycle again with even more interest on an even larger amount. From the lender's perspective, this isn't their problem. They lent you money for a depreciating asset. The loan terms don't care what the car is worth. You agreed to pay back the full amount plus interest. From your perspective, it means the car cost you money the moment you bought it, and that loss compounded if you financed it. Then there are the extras: extended warranties, paint protection, fabric coating, theft deterrence. These are sold in the finance office after you've already committed to the car. They're presented as small additions to the monthly payment, maybe $20 or $30 more, but they're financed too. A $2,000 warranty financed over 5 years at 6% costs about $2,320. And most extended warranties have so many exclusions that claims are difficult. Dealers make significant profit on these products. The margins are higher than on the car itself. That's why the finance manager pushes them hard. You're not required to buy them, but the process is designed to make refusal feel awkward or risky. The default is yes. Opting out requires active resistance. So why is the system built this way? Because every party involved has an incentive to maximize the financed amount and extend the loan term. The dealer makes money on the sale, the financing, and the add-ons. The longer you finance, the more they can upsell. The lender makes money on interest. A 72-month loan generates more interest than a 48-month loan, even at the same rate. The insurer makes money on premiums. As long as you're financing, you're required to pay. And depreciation? That's just physics. It happens regardless. But when combined with financing, it creates a situation where you're paying interest on an asset that's losing value. So the gap between what you owe and what it's worth grows faster than it closes. None of this is illegal or hidden. It's just structured so the full cost is spread across multiple categories and stretched over time. The monthly payment looks manageable. The total cost doesn't reveal itself until years later. Here's what this looks like in practice. You finance $27,000. You pay about $31,000 in loan payments. You spend $9,000 on required insurance. The car loses $12,000 in value. The $30,000 car cost you over $52,000 to own for 5 years, and at the end, you have an asset worth $18,000. You didn't get scammed. You agreed to every line item, but the structure made it nearly impossible to see the full picture up front. And if you traded in early, say at year 3, you might still owe $15,000 on a car worth $12,000. To move on, you either pay the difference or roll it into the next loan, which means the next car starts with hidden debt from the last one. This is why people describe car payments as never ending. It's not that the loan doesn't finish, it's that the system is designed to encourage rolling into the next one before the current one is paid off. Once you see this, the sticker price stops being the main number. The real cost is what you pay over time, in interest, in fees, in insurance, in depreciation, in equity you never build. This isn't about whether financing is good or bad. It's about understanding that a car loan isn't just borrowing money. It's entering a system where multiple parties extract value at every stage, and you're covering all of it. The monthly payment might fit your budget, but the total cost is written into the structure long before you sign.